It happens all the time. People save up enough money for a down payment for a home, they're ready to buy. But then they find out about closing costs and they were not prepared for all the extra cash they might need in addition to their down payment money. Well, don't let that hit you out of left field. Watch this video, find out what closing costs are, how much they typically are, and what you can do to potentially avoid having to pay them. Hey, it's Matthew Scher, sharing my experience once again from the Real Estate for Atlanta team at Maximum One Realty. This video is part of a series about the home buying process, and we're discussing closing costs, which is something that hits a lot of, especially first-time buyers, out of left field. I actually don't like the term closing costs because it makes the buyers feel like, wait a minute, you mean I'm buying a $300,000 house and I've got to pay an extra $9,000 to buy it? So that's really like I'm paying $309,000 for this $300,000 house. It makes people feel like they're perhaps overpaying or like it's not a good idea to buy a home. So the word closing cost is really a misnomer and a very poor choice of words. The majority of those closing costs are not actually costs. They're things that you would pay in the future that they force you to pay in advance, but they are actual costs of owning the home that you're paying in advance. So let's break it down. Let's talk about what these fees and costs are. Closing costs come in different categories. So the first of which would be lender fees. These are actually fees. The fees that the lender controls. They might be loan origination fees, processing fees. The amount of those that the lender controls will vary depending on the loan product and the lender that you're using. So as you're shopping loans, you should not just be looking at the interest rate, but look at the interest rate and the lender fees and how much the lender's charging you for that. So the first section of closing costs is those actual fees that the lender's charging you. The other ones that are actual fees are the attorney or the title company in some states, but here in Georgia we call them closing attorneys, and they have to actually be licensed by the Bar Association. But the attorney's office is going to charge you for their fee to conduct the closing, record the closing documents, do the title work to make sure the title's clear on the property and all that kind of legal stuff. That is a fee that has to be paid. In Georgia, there are two taxes that have to be paid. There's intangible tax, which is a formula that they use based on the loan amount. And then there's also a transfer tax, which is based on the purchase price of the property. Then there's also a title insurance policy, which the attorney will be a reseller for and sell to you. Title insurance, there are two kinds. There's lender title insurance and owner title insurance. If you have a loan, the lender is going to require you to get the lender's title insurance that protects their interest. The owner's title insurance in Georgia is actually optional, but you're crazy not to get it. You pay for it one time at closing, and it covers you for as long as you own that property, even if you refinance it in the future. Those are pretty much the pieces that are actual fees. And on a $300,000 purchase, off the top of my head, you might have maybe about $3,000 or $4,000, maybe $3,000 of those actual fees. But the other $3,000 to $6,000 of closing costs are not really costs. The other ones are what we call prepaids. For example, they're going to collect, when you close, the bank will collect prorated interest for the month of your closing. And then from that point on, you pay interest in arrears. Let's work through an example to explain how that works. Suppose you're closing on your house on April 15th, okay? The bank is going to, at closing, as a closing cost, collect about a half a month's interest or half a month's payment, which is all the interest for April 15th through April 30th, okay? Then you'll start accruing interest on May 1st. Your first house payment will not be due till June 1st. And on June 1st, you'll be paying for the interest that accrued from May 1st to the end of May. If you close in the beginning of the month, your closing costs will be lower. I mean, if you close in the end of the month, because let's say it's the last day of the month, they're only going to collect 1 day of prorated interest. But guess what? 31 days later, you got to make a house payment. If you close the first day of the month, you're going to have almost a full month, almost a full house payment of extra closing costs. But now you got 59 to 60 days before your first house payment. So it's a pay now or pay later scenario, and it's not really a cost. The other closing cost is prorations of taxes. You will pay property tax from the day you take ownership of the house. But depending on the time of year, when the tax bills come out in that county, if the seller has already paid the taxes for that year in advance, then you, as the buyer, will have to reimburse that seller for the taxes they paid in advance from the closing date through the end of the year. So that'll be a cost to you. If the seller did not pay their taxes yet for that year, then the seller will actually give you a credit, which is a negative closing cost. It takes away from the cash that you need to pay for January 1st through the closing date, but then you'll be responsible for the entire tax bill when the taxes bill comes out and is due. The other thing is your first year of homeowner insurance premium is another closing cost that they make you pay up front so your home is insured for that first year. And finally, there are what's called impounds, or kind of prepaid, what I call seeding your escrow account. When you make your payments on your house, you typically have money added to your monthly payment. You pay principal, interest, taxes, and insurance. So they would take approximately 1/12 of the annual tax bill and add it to your monthly payment and put that money aside so that when the tax bill comes out, instead of you having to write a check, the bank has already collected that money throughout the year and put it into a special account called an escrow account. And then they get the tax bill and pay it on your behalf. Well, if you're buying a house, let's say in Cobb County where I am, the tax bills come out in August and they have to be paid by October. Well, if you're buying a house in August, okay, the bank needs to make sure that by the time, well, that's a bad example. If you're buying a home in June, okay, your first house payment's not going to be till August 1st. The bank has to make sure they have enough money in the account to pay the tax bill and your insurance renewal when that comes due. So there's a whole formula that they use to figure out how much they have to start your account with so that the number of monthly payments you have between the closing day and when the next bill is due, they figure out to make sure they have enough money added to that account so they have enough to cover those anticipated bills. And that's also part of your closing costs. Now that we know what the closing costs are, what they're comprised of, and how much they are, let's talk about who pays them. Well, the buyer is responsible to pay all of those closing costs. But what a lot of buyers did in the old days, before we got into an extreme seller's market, a lot of buyers would write offers that would say, we'll pay so much for the house, but we want the seller to contribute X amount of dollars to pay our closing costs for us. This was very common, and in fact, it was so common that it became a misnomer, and buyers kind of got the idea that a seller is supposed to pay the closing costs for them. That's not the case. As an example, let's say a house is $300,000. Okay, if you make an offer of $300,000 but you ask the seller to pay $5,000 of your closing costs for you, you're really offering $295,000. Your offer is exactly the same as a $295,000 offer. It is not a full price offer. Okay, if you want to make a full price offer on a competitive bid situation and you want to actually get the house, you'd have to go to $305,000 to get $5,000 in closing costs. The problem with going to $305,000 is you run into issues where it might not appraise for $305,000. That's a whole separate video about appraisals, so I encourage you to watch that. That's why, in order to be an effective buyer in today's market, you really need to have enough cash to pay your down payment money and the closing costs. We can try and hope that it works out, that we can structure a deal so that you can hold on to that cash and not use it to pay closing costs. But you've got to have that money. You have to be able to do it in the event of an appraisal issue or something else until the market changes. If the market shifts and it becomes a buyer's market, then I'll be the first to say that the time has come where buyers can confidently go out there and know that they don't have to worry about having the cash to pay their closing costs because they can get the seller to do it. So hopefully that answers your questions about closing costs, what they are, how much they are, who has to pay them. If you have any other questions that weren't answered, please comment below. I'll do a follow-up on the video. I'll answer any questions that you have. And I look forward to, if you like this video, go ahead and click subscribe right now. Share it with your friends and comment below. I will publish a video every Friday, so please come back, and I look forward to seeing you on my next video night.